Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Hello, this is Aaron Blazinski, Portfolio Administrator at Fairport and Lima Wealth, with another edition of Fairport Flash. Joining me today is Fairport and Lima Wealth Portfolio Manager Jason Adams. How are you today, Jason?
I'm good, thanks. It's good to share the studio here with you, Aaron.
Absolutely. Glad to have you. So for those of you who are recurring listeners, you may have noticed we are now going with a bit of a different format. Jason and I will have more of a discussion around some topics relevant to your investments and the economy, as opposed to a lecture on a singular topic. Please feel free to let us know what you think about the new format. And with that being said, let's get into it. So Jason, as of yesterday's close, the S&P 500 is currently down roughly 13% year to date. At one point this year, it was briefly down 20% from the S&P's recent all-time high. The NASDAQ is currently in a bear market, down 21% year to date at the close yesterday. So my question for you is, do bear markets always happen during or leading up to recessions? And what does history tell us about the relationship between bear markets and recessions?
I will say that every recession has been associated with a bear market. However, we've had several bear markets that were not accompanied by recession. In total, since 1928, which is obviously the start of the Great Depression, there's been 25 bear markets. And of those, 56% have seen recession, while 44% have not. On average, bear markets experience losses of 36% and tend to be short-lived, lasting between 9 and 10 months. Comparatively, the average bull market gain is 114%, with an average length of a little less than 3 years. A couple more interesting facts about bear markets is that before World War II, 1945, bear markets were happening about every 1.4 years, and since World War II, it's now increased to every 5.4 years. As the business cycle continues to lengthen, we've really seen it these last few business cycles. If you look at the business cycle, obviously we're only a couple years removed from the COVID recession. But before that, the previous recession we had was the Great Financial Crisis in 2008. So that was an extremely long business cycle lasting 12 years. Before that was the tech bubble bursting in 2001, which was a 7-year cycle. And then obviously the one before that was the longest expansion we've ever had, going from that 92 period until the tech bubble burst in 2001. One last thing on bear markets before I throw it back to you, Aaron, is that it's interesting that half of the best trading days of the S&P 500 over the last 20 years occurred during bear markets, and another 34% of those days of the best trading days happened in the first 2 months of the bull market before it was clear that the bear was actually over. And I think the message there is don't try and time this.
Yeah. So that's actually what me and John were talking about in the last episode, was how the best days often happen near the worst days. And that's why it can be so challenging getting out, getting back in, trying to time things, as you said. One thing I want to point out to that is, you mentioned the longer and longer business cycles. Prior to the 2020 pullback, we didn't have a real bear market for about 11 years, since, really 2008, 2009. And investors really got comfortable with this buy the dip mentality. This time around, we're not necessarily in a bear market currently for the S&P, but, people who have been buying the dip since December, January are hurting a little bit. Do you think we still have to kind of get over that? Do you think that we still have to feel some pain for those people that are just quick to put cash to work? Or,
I do think in time, investors will be rewarded. If you do buy when there's as much sort of pessimism, as we're seeing right now in investor sentiment, for example, you could talk about the institutional investor survey. You could talk about put call ratios. You could talk about a lot of different sentiment indicators that suggest investors are pretty negative right now. And I tend to think over long periods of time, investors will be rewarded, for putting money to work in these types of environments. But I think, what you're saying about buying the dip, it's a little trickier this time because we are not going to get the Fed put. Right, the Fed's not going to step up and come rescue the markets and give the all clear by cutting rates or stopping quantitative tightening or anything like that because of just what an issue inflation is. But, I think getting back to your first question and really, bear markets and recessions, I think that's a really, really important topic, because I think that's going to dictate sort of the depth and the length of this particular bear. And I would call it a bear. You didn't, I think we got to like 19.8% on the S&P 500 somewhere when we
touched it,
right,
for
so it was
a
really
day
close.
or two.
So I'm just going to call it a bear.
I mean, yeah, we hit the bear market territory. I'm saying we're not currently, in like a prolonged, we're not down more than 20% for like the NASDAQ is. The NASDAQ, we've been down 20% for months.
But, I think that question about, whether this bear will be accompanied by recession is a hugely important question.
Absolutely, and I'm glad you mentioned that because my next question leads to whether or not we're going to have a recession this year or next. There's been a lot of talk recently about whether the United States will enter a recession in 2022 or 2023. Personally, I must admit that those arguing that we will have a recession do have a compelling case, as we see surging food and gas prices, war in Europe, and a Federal Reserve determined to kill inflation. Jason, given all these challenges, do you think it is possible we can avoid a recession in 2022?
I do. I think it's probable we avoid a recession in 22. Probable. Although I will say that, I say that with less conviction today than, maybe I did, in March or February. And there's several reasons why I think we can avoid recession. But before we get into that, let's talk about some of the things of why the rhetoric around that we are going to have a recession this year is increasing. Just in the first quarter of this year, first half of this year, and we've seen a few things. We come in and monitor the markets and economic data on a daily basis. And, one of the things that first caught my attention, that first sort of planted the recession seed, was when the 10-year to 2-year yield curve inverted. And, that was one thing several of the strategists that we follow sort of, you started to see a little bit more talk of recession, from the economists and the strategists.
It's often the first sign.
Right. So that was one thing. Has there been anything else sort of in the first half of this year that sort of caught your eye and maybe got you thinking along those lines?
So what's really catching my eye, and this is, I actually have a piece of data from as recent as this week, and we saw it from Target, is, how much excess inventory they had. They had a huge profit margin warning that they sent out to investors, and that's kind of got me thinking, how much demand did we pull forward? How many companies, have too much inventory? We saw all those ships sitting outside the Port of Los Angeles in 2020 and 2021, and how much of the inventory do we not really need? And now we're kind of, I think, paying the price for that. And, my concern is, you only need to buy so many, refrigerators. You buy a refrigerator, you only need to do it once. You redo your kitchen, your bathroom, you only need to do it once. And we did a lot of those things in 2020 and 2021. And I'm just wondering, how long can the party go on? You couple that with, the rising gas and food prices. I mean, I think it's really difficult for people to justify large purchases, discretionary purchases, after you just spent $100, to fill up your gas tank, and then you went to the grocery store and spent $300 on a week of groceries. So I think, it's very challenging for the consumer. But, we put a lot of cash out there, and consumers still do have a lot of cash. So I think, that's kind of the give and take from my point of view.
Yeah, no question. And a couple of the things that, again, are that pro-recession side of the argument would be the big decline we had in the Dow Jones Transportation Index. That's an index that's often considered a canary in the coal mine for the economy as a whole. So we got that 20% correction out of the transports in the first quarter. That was something that caught my eye. In I think it was our March edition of the Fairport Flash, I did a deep dive on inflation. And of the, the periods of inflation in excess of 5% that we've experienced since World War II, I think that this is the 7th. So there were 6 prior to this. Recession happened around or during each of those periods, which was another sort of thing that caught my eye. And then in the first quarter, the GDP contracted, right? I mean, it was down 1.5%. I mean, largely due to trade, basically imports growing much faster than exports, as well as a small decline in inventories. So it's a little bit misleading because consumption was actually 2 to 3%. So again, still, healthy undercurrents within that GDP report. But remember, the definition of a recession is 2 quarters of negative growth. So we've already got one. And right before we came over here, I checked the GDP FedNow model, which is something that we follow pretty closely, and it was revised down now for the second quarter to just 0.9% growth. So we're getting pretty close when you're looking at some of the things out there. Another thing that kind of jumped out at me would be consumer sentiment. The University of Michigan's report on consumer sentiment, it's the lowest it's been since 2011. And I really think why that is, you just talked about it. It's the price at the pump, it's the price at the grocery store, all these things that we need to buy that are up in price considerably. So that's also some of the reasons why I think this pro 2022 recession talk is gaining momentum. But the reason I mentioned that, I think it's probable that we avoid it. And Aaron, if I were to ask you, what would be the number one reason you think if we avoid recession in 2022, what would be your answer as the number one reason?
The reason why we do?
If we avoided recession. So what would you point to as the reason why that we would avoid recession in 2022?
For me to positively say that we're going to avoid recession, I would have to see gas prices, oil prices, commodity prices, specifically food, come down substantially. And perhaps I'll throw another reason in there is the Federal Reserve kind of pumping the brakes on things.
Yeah, I couldn't agree more. But of the things that are currently happening in the economy, what is something that you would point to as an area of strength that might allow this economy to remain resilient through the Fed fighting inflation?
Oh, probably what I mentioned earlier, just consumer balance sheets, consumers having a lot of cash to spend.
That's a great answer.
But, the reason why I don't completely agree with that is the consumer expectations thing and what I said earlier about gas prices and food prices. We can presume a recession. We can put ourselves into a recession. I'm big on George Soros' theory of reflexivity. Your expectations can cause things to happen. So I think, maybe you can afford to take that trip to, Europe. But, you see all these headlines about possible recession on the horizon. You're concerned about losing your job or something. Maybe you don't do that. So, that's kind of where I'm coming from, with my statement about the cost of non-discretionary living.
Yep. I think the number one thing and what has me feeling like this economy can remain resilient through the significant challenges it's facing is the labor market. In May, payrolls were up 390,000. Unemployment rates at 3.6%. Nominal wages and salaries on a quarter-over-quarter basis in the first quarter versus the fourth quarter on an annualized basis are up 10% in the first quarter. Average hourly earnings up more than 5%. Wages and incomes are increasing. If you look at weekly continuing jobless claims, they continue to make new lows. And if you look at job openings, there's still over 11 million job openings. So you have this remarkably strong labor market, and we've never had a recession with a strong labor market. If you go back and look through different recessionary periods, it's just not something that's really ever happened before. Now, that obviously that can change fast, but I think that would probably be the number one thing I would point to in terms of why I think we can avoid recession this year. A couple others, the 3-month to 10-year, we talked about the 2-year to 10-year and how that inverted. But the 3-month interest rate versus the 10-year rate remains very steep. And, I think until that inverts, I think the economy can stay healthy. Every single recession that we've had has been preceded by the 3-month exceeding the 10-year. Corporations, after a banner earnings year in 2021 with earnings growth of over 30%, are in great shape for CapEx, share buybacks, dividend increases. I think Evercore ISI, one of our research sources, put out a survey today on CapEx showing just how resilient that's remaining. So, I think you're going to see a lot of buybacks, corporations buying back their shares. I think you're going to see continued dividend increases, and the CapEx environment should remain pretty good. And then one other thing that's, I think encouraging would just be looking at credit spreads. We're up off the lows, but we remain pretty low on historical standards. If you look at the investment grade spread, so the average spread of an investment grade bond versus a treasury is about 179 basis points right now. That's a little bit higher, or 1.79%, a little bit higher than than the lows we've experienced last year. But, I think if you talk to fixed income strategists, I think they would probably say once you get to that 325 basis point or 3.25% spread between a corporate bond and treasury is when there starts to be some some pressure in the credit markets and a recessionary signal. So I think there's plenty of evidence to support the idea that we can indeed avoid a recession this year.
Absolutely. Those are a lot of great points. I think to sum up what you said is, look past the headlines, and if you really lift up the hood on things, it looks a lot better than, you might see on the front page of the Wall Street Journal or CNBC. So that is definitely encouraging to hear. And that leads me to my next topic. The fact is, whether you think there will be a recession this year or not, the probability that we do have one is, much higher now than it was, say, 6 or 12 months ago.
No question.
Right. So how are you changing your approach to asset allocation given the current market environment, and what things are you watching to figure out where the economy and markets are headed?
Yeah, I think one thing we started doing as early as last year is really reducing our exposure to growth and increasing our exposure to value. That we think that in an environment where the Fed is raising interest rates to fight inflation and ending a quantitative easing program and allowing longer-term rates to rise, we think assets with long duration or high levels of interest rate sensitivity, for example, a growth stock with no dividend yield, where the entire return is based on the terminal value of that particular investment, those are much more sensitive to rising interest rates than, say, a company with trading at a discount to the market with, a dividend yield, of 3%. For example. So that's one reason we started tilting away from growth towards value, was to kind of reduce that duration exposure. And we've really did that across our equity portfolios. Within our large cap portfolio, we've taken a similar stance where we're a little bit more focused on yield and valuation, as well as defensive business models. So just to give you a couple examples, we added healthcare companies with defensive business models that hopefully will provide us some support if some of the struggles the market's dealing with continue. And then on the fixed income side, we've taken similar steps by shortening duration, increasing credit quality or improving the quality of our bond holdings, and taking advantage of the increase in those short-term rates by focusing on that 2-year maturity range when buying individual bonds. Last thing I'd mention would be the use of alternative investments. And then one thing I wanted to ask you about, Aaron, would be another tool that I think makes a lot of sense would be the use of buffered ETFs, which I know is an area that you spent a little bit of time on. So maybe you could just touch on sort of buffered ETFs and the value and how they fit within a portfolio.
Yeah, sure. So buffered ETFs, for those who don't know, it's a type of hedged equity strategy. You have downside protection and an upside cap. So say, you're protected on the first 10% drawdown in the S&P 500, for example, and then you'll have a cap on the upside to say 15%. So if the S&P 500 is down 5% a year from now, you're down 0% in the funds. These have been great for us to kind of take some risk off the table on the equity side of the equation, just because, as you see this year, people have lost money in stocks and bonds. There hasn't really been a place to go or hide. And, you also don't want to go to cash and, miss out on that bounce back.
Not to mention inflation eating away at that cash.
Yeah. So you don't want to be in cash. Yeah. If you had cash, you lost,
right,
money this year as well. So like I said, nowhere to hide. And, a lot of folks don't want to be out of the market completely, but they do want to see their risk profile change. And I think this is a great way to do that, just because you're protected. And unless things really go bad from here, you're pretty safe on the downside. So I think it's a great option for people that do want some return and are willing to take a little bit of risk, but not, the full, market risk. But, they worked well for us, and I think it's a great strategy, like I said. Something we're definitely going to keep utilizing, as we ride out the choppy market. So
I agree.
So Jason, as we wrap up here, is there anything else you'd like to add?
The only thing I'd like to add is just, some of the things that we're watching, as this debate around recession continues to occur. Watch the inflationary data, the consumer price index, the producer price index, the price deflator within the GDP report. The labor market's going to be hugely important. And then the leading indicators. So you have the ISM survey, which is released the first Tuesday of every month. That shows you how manufacturing is doing. You have the Conference Board Leading Economic Index, which I believe is released the third week of every month. The slope of the yield curves, as we talked about, is going to be extremely important. Durable goods and building permits is another widely followed leading indicator. And then obviously the stock market itself. So, and then we'll see what management teams say during this second quarter earnings season. And then other than that, just a huge thank you to our clients. We value your relationships, and we value the trust that you put in us. And again, couldn't be more thankful. So with that said, Aaron, I can throw it back to you.
Yeah, so I think that is all the time we have for today. I just want to say thank you, Jason, for taking the time to come on the podcast and share your thoughts. We hope you enjoyed this episode of Fairport Flash. If you have any questions about your investments or the current market environment, please reach out to your Fairport or Luma Wealth Advisor. Until next time, wishing you and yours all the best.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.